There's a move called the Backdoor Roth IRA that lets high-income earners park up to $7,000 a year, $14,000 as a couple, into the most powerful tax-free retirement account in existence, completely legally, even when the IRS technically says they earn too much to qualify, and your financial advisor has almost certainly never mentioned it. Let me set the scene. You're doing everything right. You earn good money. Maybe you crossed $161,000 this year, or $200,000, or $250,000. And at some point someone told you about the Roth IRA, the account where your money compounds completely tax-free, the gains are entirely yours, and when you retire you pull it all out without writing the government a single check. You got excited. Then you looked it up, and you found the income limit. Single filer making over $161,000, you're out. Couple earning over $240,000, door closed. Contribute elsewhere. Move on. Except the door isn't actually closed. There's a side entrance, and the wealthy have been walking through it since 2010. Here's what the Backdoor Roth IRA actually is. It is not a gray area strategy. It's a two-step legal maneuver sitting in plain sight inside the tax code. Congress removed the income limit on Roth conversions, not contributions, conversions back in 2010. That single word is where the entire strategy lies. Step 1. Open a traditional IRA. No income limit to do that. Contribute $7,000, the 2024 limit, as after-tax money. Don't take the deduction. Step 2. Wait a day. Then convert that balance directly to a Roth IRA. The IRS allows conversions at any income level. Because you already paid tax on the money going in, the conversion is essentially tax-free. And now that $7,000 is sitting inside a Roth, permanently untouchable by the IRS on the way out. Run the numbers. $7,000 a year for 25 years, growing at 8% annually, that's roughly $540,000 at retirement. Every dollar of that growth is tax-free. A couple doing this together, over $1 million, zero federal income tax owed. From a strategy that doesn't appear on a single income limit chart you've ever seen. And this isn't even the best part. There's a version of this exact same move designed for business owners that shelters not $7,000 a year, but $69,000. Same legal framework. Dramatically bigger number. We're getting there. But first, here's where it gets interesting. Nobody teaches this, not your HR department, not the January statement your brokerage mails you, not the advisor who earns a commission selling you a whole life insurance policy. The IRS is not in the business of sending you a letter explaining how to legally bypass their own contribution rules. And the professionals who do know, the CPAs who service eight-figure clients, the private wealth managers who charge 1% of assets under management, aren't broadcasting this to the general public. It doesn't serve them to. Here's exactly how you know this was always designed for insiders. In actual congressional testimony, legislators called this the rich person's loophole. That's not a nickname from a personal finance blog. That's the phrase used in a formal debate about whether to close it. They didn't close it. Now the caveat, and it genuinely matters. There's something called the pro rata rule. If you already hold pre-tax money in any traditional IRA account, the IRS calculates taxes on your conversion based on the ratio of pre-tax to after-tax funds across all your IRAs combined. Do this without accounting for that ratio and you could owe an unexpected tax bill. A CPA who knows this move can sequence it so it's clean. Done right, it's airtight. This is legal. The IRS has issued guidance confirming it. Congress has debated closing it multiple times and walked away. That's not a loophole living on borrowed time. That's a structural feature of the tax code that has survived 15 years of reform conversations. So think about what this actually means. The income limit on the Roth IRA was never a wall. It was always a gate. And the gate has had an unlocked side door the entire time. The people walking through it aren't doing anything illegal. They're not gaming the system. They simply knew the door existed. They had the right CPA in the room at the right moment. And you, until right now, were never told. That $7,000 annual contribution is the ground floor of this strategy, but there's an upper floor. A business owner who structures one specific type of retirement account correctly can shelter $69,000 a year into a tax-advantaged vehicle using the same core logic, same IRS, same tax code, a number 10 times bigger. How does that version actually work? And who qualifies? That's the next file.